Picture this.
It's the year 2000, and Enron is one of America's largest, most celebrated companies. Its stock is soaring, hitting over $90 a share, and Wall Street hails it as the future of the economy. 1 year later, the company is bankrupt. The stock is worth less than $1. More than 20,000 employees are out of a job, their life savings gone. How does a corporate giant just vanish? This is how Enron's executives built an empire on lies, cooked the books to invent profits out of thin air, and almost got away with one of the biggest frauds in US history. The company started in 1985, formed by the merger of two natural gas pipeline companies. At the helm was charismatic CEO Kenneth Lay. Lay wanted to turn energy into a financial instrument you could trade like stocks and bonds. To make that happen, he hired a fiercely ambitious consultant in 1990, Jeffrey Skilling. Skilling pushed the company into the high-stakes world of energy trading, bringing a dangerous accounting method called mark-to-market. Normally, a company counts money only when cash is in the bank. Mark-to-market let Enron book projected future profits the second a contract was signed. Years of profit claimed on day one. The method wasn't illegal, but it was ripe for abuse if projections were wildly optimistic, and Enron's were. This created a hunger for new deals to feed the illusion. Wall Street loved it, but behind the curtain, the profits were paper-thin. With imaginary profits piling up, Enron faced a problem. What happens when deals lose money, or reality doesn't match the rosy projections? This is where it escalated into criminal conspiracy, masterminded by CFO Andrew Fastow. His job was to make Enron's problems disappear. His solution? A web of off-balance sheet companies called special purpose entities. Think of it like creating a shell company to hide your debt so you look clean for a mortgage. Fastow set up a network with names like Chuco and LJM, hiding billions in debt and parking failing assets, letting Enron present pristine financials while sitting on a time bomb of hidden losses. The setup was rotten to the core. For these entities to be legal, they had to be independent. They weren't. Fastow was secretly running them, personally making millions off deals between these entities and the company he served as CFO. The auditor, supposed to be the watchdog, Arthur Andersen, simply looked the other way, cashing millions in consulting fees from its star client. The beginning of the end came without warning. On August 14, 2001, Jeffrey Skilling, just promoted to CEO 6 months earlier, abruptly resigned, citing personal reasons. Ken Lay stepped back in as CEO and assured everyone the company was in the strongest and best shape it had ever been. It was a lie. Days later, VP Sheriff implode in a wave of accounting scandals, pointing directly at Fastow's partnerships. Lay had Enron's own lawyers investigate, and unsurprisingly, they found no major problems. But the truth was spilling out. On October 16th, Enron announced a shocking third-quarter loss of $618 million, along with a $1.2 billion reduction in shareholder equity. The SEC launched a formal inquiry. Fastow was fired. In November, the company admitted it had overstated profits for nearly 5 years, erasing hundreds of millions in earnings and revealing billions in hidden debt. Confidence evaporated. On December 2, 2001, Enron filed for bankruptcy, at the time, the largest corporate bankruptcy in American history. The fallout was a catastrophe. Over 20,000 employees lost their jobs and retirement savings. Arthur Andersen was found guilty of obstruction of justice for shredding Enron documents. Though the conviction was later overturned, it was too late. The 85,000-person firm collapsed anyway. So what happened to the men at the top? Andrew Fastow pleaded guilty, cooperated with prosecutors, and served about 6 years in prison. His testimony became key evidence against his former bosses. In 2006, a jury found both Ken Lay and Jeffrey Skilling guilty of conspiracy and fraud. Lay died of a heart attack while awaiting sentencing, and because he died before his appeal was complete, his conviction was legally erased from the record. Skilling was sentenced to 24 years, later reduced, and was released in 2019. Enron's most important legacy wasn't the prison sentences, it was the law it inspired. In 2002, Congress passed the Sarbanes-Oxley Act, imposing stricter controls on auditors and dramatically increasing accountability for CEOs and CFOs. Enron became the textbook definition of corporate fraud, a lesson in what happens when ambition goes unchecked by ethics. If you find these deep dives into financial scandals compelling, subscribe and hit the bell so you don't miss what's next.